the internet is a massive, massive store, and you can reach 7 point something billion people on the internet. And so as an e-commerce founder, why would you limit yourself to the people who, speak your language, or at least who can walk to your headquarters?
Hey everyone, welcome to another episode of Perfectly Mentored. I'm your host, Jason Portnoy. My guest today is Andrew D'Souza. He is the co-founder and CEO of Clearbanc, which is the largest e-comm investor in the entire world, with over $1 billion invested in over 2,800 companies. Andrew is a brilliant man who comes from the consulting firm McKenzie, and his Silicon Valley path into this world is just remarkable. This is a great episode talking about VCs, talking about e-commerce, talking about everything you need to know in order to grow your business and get financing and funding in order to grow your business. You're not going to want to miss this one. Check it out. Thank you so much for doing this. Really good to have you here.
No, thanks, Jason. Great to be on here.
So, let's start here. Let's tell us a little bit about your entrepreneurial background and how you got started all the way to Clearbanc.
Yeah, sure. So I'm an engineer, studied engineering at the University of Waterloo in Canada. Spent a couple of years at McKinsey, and then met a guy named Chamath, who was head of growth at Facebook in 2010. And he convinced me to move out to Silicon Valley. And it was either join my team at Facebook or join this 4-person startup I'm invested in. And the 4-person startup sounded like more fun. I think pre-IPO Facebook might have been more lucrative, but hindsight. But I learned a lot, coming down there. I think that was just as Silicon Valley was coming out of sort of that financial crisis and new funds were starting. Andreessen Horowitz had just started their fund. They were a seed investor in the company. And Chamath was on our board, and we had a great group of people around the table. But I would say probably one of the most eye-opening things for me was moving down, an immigrant, moved to Canada and then moved out to the US. And one of the most eye-opening things for me was this idea that, I met all these founders that I had read about, the founder of Dropbox, the founder of Instagram and Slack. And this was before, this was when Instagram was still bourbon, and Slack was still tiny speck. Right. And I met these guys, and I'd read about them, but I realized that they were no different than my friends back in Waterloo that were starting companies, my friends in Europe or India or wherever else they were, other than the fact that they had easier access to venture capital, right? They went to the same parties as the VCs, and they got to know them. And so when they started their businesses, they were able to raise money, and then that allowed them to get in the press and then hire better talent and, get customers. And so I think that was one of the things that ended up being a theme in my career, even as I moved back to Canada and as I moved around the world, was, how do we actually help more founders, regardless of where they grew up, where they live, what school they went to, what product they're selling, to get access to all the benefits that Silicon Valley has afforded, a relatively select number of people.
So before we even talk about Clearbanc, where you're at right now, and for the listeners not familiar, I'd love for you to go deep on what it is. What did you learn from working at I've always wondered this, I'm a big fan of consulting groups and consulting in general. What did you learn from McKinsey that you brought over to Clearbanc?
Yeah, I think there were a few things that I learned. One was how fast you can learn a new industry, right? We would jump on a new project, and we'd have 24 hours to learn an entire industry before we had to start sounding knowledgeable on it. And you're like, hey, you could actually learn all the relevant stuff pretty quickly if you just dedicate yourself to it. And then maybe that whole theme of how much you can get done in a day. We had, you'd show up at 7 a.m. We had a 10 a.m. meeting. It was great. What's happening? We have a 10 a.m. meeting with a client. What do we have to get done in the next two and a half hours? Come out of that meeting, okay, we've got another one at 1 p.m. What are you going to get done? And so you sort of had that pace of you'd get a week's worth of work done in a day, and you'd move. It was energizing because you would make so much progress. You think back to what did where were we on this project in the morning, and it felt like you were miles ahead of that. And I think that was what kept me going. The hours were rough, but probably not that different than what I'm working on now as a founder. But I think this idea that let's schedule a meeting for next Tuesday, that didn't exist at McKenzie. We really, at ClearCo, we try to not do that either. It's like, if it can get done now, if it can get done today, let's have that conversation now.
And I'm curious, because you've got to see so many different businesses there. What are some of the commonalities, or that I guess not what they're doing, maybe what they're doing right, but also what most businesses are doing wrong that you've seen?
I mean, we worked with very large clients. I worked, this was again 2008, 2009. I worked with media companies, and I think one of the biggest challenges for any business is when you know what the future looks like, but it's irrelevant to the scale of your business today, making that investment, right? And so we had all these media companies that made all this money in magazines, radio, TV, and they were like, yeah, we know that digital is coming. Like, we know that, e-commerce, we know digital media, like, Facebook wasn't really a thing yet. Like, we know it's coming, but our executives are probably going to be retired by that point. So let's just ride out our, radio royalty streams and advertising streams, right? And so I think, that was one of the things that, and you see it time and time again. The companies that are willing to mortgage sort of today, or like willing to like bet on the future, are the ones that are, and it's, Jeff Bezos talks about day one, right? It's like, in order to build what could be a really enduring company, you always have to be in the situation that you're willing to throw everything that you've built, even if it seems large and valuable. You have to be willing to bet it all for what you have conviction on as the future.
Well, fat cats get lazy, right? I think that's
Exactly.
that's number one. And Mark Cuban always says this, right? About looking for ways to put yourself out of business is the best way to stay in business.
That's it. Exactly.
So now on Clearbanc, what for the listeners who aren't familiar with it, why don't you tell us a little bit about it?
Yeah, so we're trying to be a alternative investor. So we try and like I mentioned, bring all of the benefits of a VC firm without any of the downside. So I'll give you a little bit of color around what motivated it. I had moved back to Canada. Because I'd spent time in Silicon Valley, people had asked, when I joined a couple of different companies, my first job was to go raise capital for them. And so I got back on a plane and sort of pitched the investors and did that. So I did that for a SaaS company called Top Hat, an education tech company. I did that for a hardware tech company. And with the hardware one, we ran a really efficient process. We got a great valuation from a firm that we didn't know particularly well. And then, 6 months later, we missed a number, and those investors sort of said, hey, we're taking over now. We're going to bring in our own people, and we're going to, we've got it from here. And so I think that's one of the areas where, I realized that, like, with, there are some downsides in selling equity and ownership and control in your business. And a big part of my mission at that point became, how do we help, how do we actually invest in companies without them having to make that trade-off? And so what we do is we fund businesses on a revenue share basis, primarily e-commerce, but e-commerce, software, mobile apps, and SaaS companies. And if you sell your product online, we'll fund your customer acquisition, your marketing and user acquisition, or your inventory. And we take a share of revenue until we get our money back plus 6%. So we give you $100,000 to spend on marketing. We'll take 5% of sales till we get 106 back.
Got it. So, I mean, is that the major value prop that really gets companies to choose you as a route for funding, like the equity free piece? Is that really the main value prop, or is there more to it?
Yeah, that's the hook. I guess that's the reason why people come to us is, that's the top of mind for every founder is like, do I have enough funding to keep my business going and to achieve my goals? And we kind of created a new way of thinking about funding. But in reality, capital by itself, you can get anywhere and you can just decide sort of what type of capital you're looking for. What we're really trying to do now is bring all of the benefits of having an experienced investor. We've seen 25,000 businesses now. We know what works. We know what doesn't work for which category, at which stage, in which geography. And we can actually advise our companies on, okay, here's $100,000 to spend, but you probably shouldn't spend it on Facebook right now. You should, your category is doing really well on TikTok, and so you should spend it here. Or a combination of direct mail and email, it could actually work well. Or, your click-through rate is great on your ads. Your agency is doing a great job, but your conversion rate on your website is well below your average. You need to improve your conversion, your conversion rate, website load time. Here are some partners that can do that. So we're really starting to get into the advisory, like what you'd look for in a board member or an investor that's done this before. My partner is on the Canadian version of Shark Tank, Dragon's Den, Michelle, and so she, a lot of people go on there and they're like, look, money's great, but I actually need somebody who's done this before, and we can sort of do one better, where we can say, this is what the data is showing in real time.
Love it. So more than just dumping money in them like a regular VC does and says, go do it. Go get clients, go get more customers. You'll actually take on that role as advisor.
Yeah, exactly. Without, you don't have to listen to our advice, right?
Yeah.
But we know what works. And so if if you have a secret sauce that works better than what we know, by all means, use our capital and execute your strategy. But if you're looking for some advice on, what we're seeing in the market, we'd love to be able to help as well.
Is there a niche that's been working really best for you guys right now?
One of the things we launched actually earlier this year was a product called Clear Angel. And so these are for businesses that are just starting. One of the things we looked at, so we funded $2 billion to about 5,000 businesses now. And we looked at our data, though, we said no to 50,000 businesses. And that's because they didn't have enough history, or, they didn't have a repeatable business model. What we always tell people is, if you once you know that you put $1 in and you get more than $1 out, either in marketing or inventory, then you shouldn't raise equity, right? Equity is way too expensive. But if you're still figuring it out, then maybe you do want to raise some venture capital or some equity, because if you're investing in R&D and product development, you don't know if the product's going to work, you don't know if people want it, then that's a great use of equity. And so we launched this product called Clear Angel, which kind of more simulates an accelerator program or an equity investment. We still don't take ownership in the company, but what we do is we say, look, we'll give you $25,000. We'll take 2% of sales until we get, for 4 years. And we'll put you through a program. So we'll match you up with a coach. You'll get access to a network. We'll give you a set of objectives, and we'll take companies as early as, $1,000 or $2,000 in revenue. And we can scale them up to tens of thousands, hundreds of thousands, or millions of dollars in revenue in those 4 years. And it's a new program, but it's been really, really well received so far.
So, I mean, you said something interesting where it's like, if you're putting $1 into advertising, you're getting more than $1 back. I'd love to just expand on this, because we live in the ROAS, the higher, the better. I need this, I need my 5X return, which, I mean, just is crazy, because 10 years ago, no one was even talking about these as a metric, when they were putting up a billboard. What's your take on what's going on and working with so many different businesses and seeing them grow? How do you map out, and I guess we're kind of going in a different direction here. Like, we're moving towards where tracking's becoming more and more difficult. It's not going to get easier. All the platforms are now going to have issues. How should businesses start looking at ROI or ROAS and start looking at that when it comes to their own business?
Yeah, it's a real challenge. I think if you've grown up in the heavy analytics world, where you could track every pixel click and every track a user across the internet,
the spoiled world where we got data instantaneously, right? For the last 5 years. Yeah,
we're sort of swinging a little bit back to not all the way back, not nearly all the way back to the traditional world where it was these massive media buys, but especially coming out of the pandemic. In an omnichannel world, I think the businesses that do the best are the omnichannel businesses, right? Meet the customers where they are, but you build a relationship with them across multiple channels. And this is one of the most challenging things, because a lot of people, you start by advertising on Instagram, and you can build a pretty sizable business by advertising on Facebook and Instagram and build a direct response business. But if you want to build something, and I think the real question is, if you want to build a stable cash flow business and you're not that interested in growing it, you can do that, and you can optimize for your 5X ROAS, and you can continue to tweak, the ad sets and refresh the creative, and you'll generate a pretty, high margin cash flowing business. But if you're trying to build
at no scale, at zero scale,
right? It's a great sort of side hustle hobby, and you pick up the customers when the ad prices are cheap. But if you're trying to build a scalable brand, then you need to be able to think about, full funnel. And one of the things that's interesting is sort of testing some of the programmatic ads, some of the out of home. I mean, it's really interesting as you start to think about out of home and TV. We've seen some of our most successful businesses run, out of home, TV, direct mail, and direct response. And you can do this. I mean, there's actually great ways to buy programmatic ads by geography, by postal code, by zip code, whatever. And you can run these tests, and you can model out the lift that you get. You've got to think about your time windows a little bit differently, but you can model a lift of like, hey, I'm going to run this ad for this week, and then for the next 3 weeks, I'm going to see what the lift I get on my direct responses compared to an equivalent geo that doesn't have that. It's hard. You can't control for every variable. The statisticians are gonna struggle with this, but you have to have a little bit of conviction, and you probably have to make some gut decisions on less data. And this is another area where we try and help, because we've seen it across a large portfolio. Because you're right. I mean, with iOS 14, it's getting harder and harder, and a lot of people are scrambling right now to think through, what does that media mix really need to look like for my business to achieve its objectives.
Yeah, look, even before this, I've always believed we were spoiled with the data. Like when I started running ads, we had to manually calculate returns, and it wasn't even like that wasn't the vanity metric at that point. Even at that point, I think businesses kind of have to start looking. I want to hear your thoughts of it, because my thought was always from an MER standpoint of like, how much of your revenue are you prepared to spend on acquiring new customers, and always look at that as like, so let's say you want to be at 25% of revenue to acquire new customers from an advertising perspective. Well, then great. The ROAS doesn't matter as long as you're making revenue and growing and you're within that 25%. That's kind of how you have to look at it. I'm wondering if you're seeing that trend as well right now.
Yeah, I mean, I think for the people that are thinking about their business more holistically, we certainly are. I think one of the things that for fewer people think about, or fewer marketers, direct response marketers think about, is the margin profile, in the direct response. And I think this is one of the areas where, as you think about, so you think about the MER, and you think about your media mix, and then you think about your inventory purchases and the actual sort of COGS that you have in your products, and then you think about your pricing flexibility. You almost want to start to think about like, how much of your free cash flow are you interested in spending, right? And what are the opportunities for you to optimize free cash flow? Because again, and this is where, if you have access to financing, like, you can actually start to think about this a little bit more strategically. You can say, look, I'm going to make a more aggressive media buy, and I'm also going to make a more aggressive inventory purchase. And with my more aggressive inventory purchase, I can actually reduce my my COGS, and assume that the media buy is actually going to sell through that inventory. And so you expand the free cash flow of the business. So I think that's one of the areas that, the most sophisticated people are starting to think through the margin profile alongside the ROAS side of the business. It's historically been like, hey, I've got my supply chain team, and I've got my, marketing team, and they should never talk. And I think, if you can get creative, you can actually start to do some interesting things there.
I love what you said earlier about being omnichannel. I'm a big believer in omnipresence, and the ability to dominate your market or achieve market domination requires you to be seen everywhere. But now with attribution, right? How do you make those decisions if you're a direct to consumer company and you're trying to be as strategic as possible? The delta is so wide sometimes, let's say on Facebook versus now adding in Snapchat versus Pinterest, and they're all attribute their sales a bit differently. How do you advise, the businesses that come work with you around still being omni-channel, but also understanding that there's that double dipping, for lack of better words?
Yeah, it's, I think we haven't seen a great attribution model. A lot of people have tried to. A lot of people have tried to.
Honestly, I think that's the $1 billion industry. If you could like come up with like a way to correctly attribute every sale, that's a $1 billion business. But yeah.
What I've seen work best is you really just try and optimize a media mix, and you sort of say, look, here's the mix. You try and control for as many other variables on seasonality and things as you can, but you sort of, I think it's almost like portfolio theory, right? That's going to, because if you try and get down to the attribution of an individual sale, which is what every platform wants you to do, and they want to try and take credit for it, and they've got their own tricks to do it, you can wind yourself up, and you can kind of lose the forest for the trees. So I think probably the best way to think about this, especially if you're starting to think about omnichannel, is what is the right media mix? How do I start to introduce some new things? As I introduce a new channel, does that lift my overall performance or not? Because it is, at the very least, that strategy will be robust to the changes that are happening on attribution and user tracking and things like that we're going to see in this year and beyond.
ECOMM last year there's talks about in the 3-month period, it grew almost 10 years. Now with things kind of opening back up, what's the trajectory you see for ECOMM right now? And you and I were talking about this offline. How do businesses, like, they can't compare this year to LY, right? That's like comparing August to November, like the highest ECOMM sales month online, right? How do they look at it? And I'm just curious, like, we just had a huge trajectory. How does that plateau for a little bit, or is it like boom, boom, boom? And how are you advising LY comparisons?
Yeah, I think it's category specific, right? I think we're going to see anything that consumables and things. I think once consumers have been taught to buy things and subscribe to things, they're probably going to continue to do that from the convenience. But I do think that we're starting to see people want to go back to it is really the omnichannel version of this, right? So they may want to buy online, pick up in store, shop in store, have delivered. I think this is one of the things that the most successful businesses are getting ahead of. If they've built brand, customer relationships, customer curiosity in the pandemic, and then they can actually follow that customer wherever, as they're starting to get out. And I think, honestly, part of it is just people are excited to get out of the house a little bit and get out of, and so if it's like, okay, I'm going to go to the grocery store or the convenience store because it's going to be a fun thing to do. I think, if and when people get back into the office world, they're probably going to shift a little bit back to convenience for certain things. And so that's my hypothesis. We're going to see maybe like a little bit of an exaggerated dip as the novelty of shopping comes back, and then the mundaneness of shopping will probably or the inconvenience of it will probably shift people back. But I think a lot of consumers have been trained to be able to shop online, and it's just important for those brands to maintain those relationships and that visibility with their customers. And so we're seeing a lot of e-commerce and D2C businesses now starting to think through wholesale, specialty retail channels and things in order to maintain. And it's, obviously the margins on those channels aren't necessarily as good as D2C, but the customer continuity ends up offsetting it.
What about looking at like their financials? Like, so like you said, you invested, you guys funded a company, and you're now on an advisory role there, and they're sitting there panicking, looking at, this May to LY or March, April to last year when it was just Black Friday pretty much every single day. What's your advice to them?
Yeah, I would look at, again, last year was a little bit of an anomaly, and it's business by business and category by category. We care much more about the near-term trajectory, right? So like, how have you been doing, since 2020, since the beginning of this year, right? And like, are your economics sustaining and improving? We're less concerned about year over year, and we're more concerned about month over month, week over week, day over day. Or are you operating well? Are you on an upward trajectory or a downward trajectory in the near term?
So now talked about, you started like talking about the DTC space. When it comes to direct to consumer, when it comes to marketing, it's almost like the person who could pay the most to acquire the customer wins. I don't think it is. I think that's actually how it is. What do you think about that? And do you find most of the funding that you provide goes into competing on those terms?
I mean, I guess that is a little bit of it. I think it is, if you don't have a good product, then it's basically
everything we say. Like I'm going to preface this for the listeners. Any advice that Andrew's going to give, or that I talk about, or any guest talk about, all comes with the assumption that you have good product and good customer service. Because without that, no matter what advice Andrew's going to give you or any guest give you, it's not going to work. So yeah. I want to make that assumption very clear.
Yeah, I think, but I would actually take that a little bit further to
please.
The worse your product or brand reputation, the more you have to pay to acquire the customer. Right. At least maybe you have to overpay a little bit to build some sort of traction. But if you're doing things right, and if your product solves a specific enough pain point, you'll start to get word of mouth and organic that should really supplement your ad purchases and actually improve the conversions and click through. So it is actually, and there's a few different ways to start to see it. You can certainly see it in organic traffic. You can certainly see it in conversion rates, right? So if people are actually either your product is really good, or your website is really well optimized for conversion, but and then you can see it in return rates, repeat customer purchase behavior, and so I think that's one of the things that you can, if you make the right investments in product and customer experience, they actually pay off in ROAS, but over a longer time horizon.
What do you think is some of the biggest opportunities right now in the e-com space?
Again, product and category specific, but we've seen a lot of great results on TikTok. I think Snap is doing some really interesting things. Podcast advertising, I think it's very, very nascent. But as it evolves, I think we will see some great results, especially as you start to be more targeted and actually build more of an integrated experience. I don't actually know how the podcast platforms are going to be able to do that, but it should be fun to see, and I'm sure people will track it. Programmatic TV, we've seen people do some great stuff there over the top. But yeah, I mean, I think it's I think out of home will be increasingly, and that's just a hypothesis. That's not based on data yet, but strong hypothesis. We'll start to see some great stuff happening in out of home that also support the direct response stuff.
I want to go back to the funding side of things for a second.
Mm-hmm.
What's the value prop that or I guess let me phrase it this way. I'd love to know what parameters you look for as potential success indicators, like determining what type of companies would be ideal customers and would be successful and profitable for Clearbanc and a win on the client side.
Yeah, I think that it's really about do you have a repeatable, scalable process, right? And so, the way we think about funding, and what I always advise entrepreneurs to think about is what are your uses of proceeds and what's the risk, reward, and time horizon of those uses. So on one end of the spectrum, you've got equity, and equity is great to fund high risk, high reward activities that may take years to pay off, right? New products, new market entry, R&D. On the other end of the spectrum, you've got debt, and debt is really designed to fund kind of sure things, right? I'm buying equipment, I know this equipment will pay off. I'm buying an asset that in the worst case scenario, I can sell that asset and pay off the debt. Because the problem with debt is if you have a fixed maturity date, and if you don't pay it, they basically take your business, they drive you into bankruptcy, and often comes with personal guarantees. So what we try and do is we say, look, we're going to be in between. We're going to fund repeatable expenses like marketing, like inventory, like infrastructure for SaaS companies and salespeople that are, highly correlated to revenue, but with maybe some variability and some uncertainty, as they scale. And so these are, where you've got a channel where you know exactly what you want to do with the capital, that I'm going to put $1 in and I'm going to get between, $1.50 and $3 out, approximately over this period. I know what's going to happen when I invest the dollar, and I know how approximately it's going to take, 6 to 12 months or something. That's a great use case. And then those are the types of businesses we love to fund because we can continue to help grow them until they start to saturate.
When it comes to the VC space, how much is betting on the jockey versus the horse for you?
Yeah, well, this is one of the nice things about our model. When you invest equity, you're investing in the person, and it introduces a lot of bias, right? It's like, how did I meet them? Did they get a warm intro, or did they go to the right school? Like, do I like them? Do they look like me? Whatever. We really just try and put all of that aside, and we just look at the data. So the way you work with us is you come in, you plug in all your data, we'll make you offers. There's no, like, you don't have to pitch your business. You don't even have to talk to somebody if you don't want to. We've got people that are happy to talk you through how the whole thing works, advise you. But if you're just like, look, I want to see my offers. And that's actually been really eye-opening because we've ended up funding like 8 times more women than a typical VC firm. 30% of our founders are people of color. In the US, we fund people in every state, every province in Canada. 70% of our UK founders are outside of London. So it's really, you create this sort of diversity because of people that just, they may not have a warm intro. They may not be able to get their foot in the door. And then they end up building much more interesting products, right? We've got a military veteran that built a murder mystery game. We've got people that are building products for autistic children, people for specific skin conditions that most VCs just will never relate to. And so you walk in and you try and pitch like, oh, this is a real problem, and they're like, I've never experienced it, so why would I invest in it? Whereas we're like, look, if your customers are buying your product, like, we're happy to continue to back you, whether or not we understand the problem that you're solving.
Okay, I want to go back one step. I'd love for you to just go deeper on in terms of like the potential success indicators for you guys, what you look at. I know you spoke kind of like from a holistic point of view, but are there certain metrics that like you see plug in? I know repeatable systems, but are there metrics that you kind of look at and be like, they're over X benchmark or whatnot, and then you sit there and say, yes, tick off, tick off, tick off?
Yeah, I mean, we look for. I've got to look at the ROAS numbers, but it's like it's certainly like above like at least above 1 point something or 2, like at least like profit ROAS. So I think the revenue ROAS is important, but it actually really depends on the gross margins and the free cash flow. And so we pay a lot of attention to margins. We pay a lot of attention to ROAS. And then we pay attention to liquidity, right? And so like, how is this business a going concern? And then trajectory. High growth businesses we give a lot more favorability to, and then we're starting to incorporate things like how saturated are the audiences and things like that. If you're starting to use the direct response, like how close are you to plateauing? That all informs like, can you actually spend $1 million, next month? Or like, are you doing really well at 200 grand, but if we give you $1 million, your business might fall off a cliff. So those are the types of things that we're starting to look at.
So a lot of the things are more internal operation side of things, right? So it's because you could help a company fix their margins, harder to help a company, let's say, fix their cost per impression.
Right.
So you're looking at more things that you could control versus things that are outside your control.
Yeah, for the most part. Although one of the things we try and do is we say, look, we've worked with this, we've worked with XYZ agency, and they've been able to, we've seen them improve the cost per impression for businesses in your category. So we think they could. So while we may not get actively involved, we can make some targeted recommendations and then we give the founder and business owner the data to hold their agency accountable, to say like, hey, we recommended this agency because we thought they could do this. Here's where I started. Here's where I'm going. So people use that quite frequently.
Yeah. So, and do you follow the same decision-making process like regular loans, or do you look at it more like a holistic view of company operations?
So we really focus on, revenue and cash flow and trajectory. Regular loans, I mean, the banks, one of the things to understand is like banks are regulated to hold assets on their balance sheet. And so most e-commerce businesses don't have a lot of assets. They're not going to value your inventory as an asset. They're probably not going to value your brand or customer lists as assets. So what they'll typically look for is a personal guarantee from the founder. So if you own your home or investment portfolio or something, and I think this is one of the things that allows banks to give very low rates because they're not really taking any risk on your business. They're basically like, if your business fails,
We
we're
got
just
your
going to
house.
your stuff. Yeah, exactly. And so that's one of the things that was really important to us, was like not having a personal guarantee in any of our agreements. So our rates are going to be higher than things that take all asset liens, personal guarantees, because we don't really look at the assets of the business. We're not going to be in the business of seizing assets and liquidating them to get our money back, right? We're just going to be in the business of trying to help you grow your top line revenue.
Got it. And so I guess we'll part with this one. We'll kind of wrap up with this thought. If you're an e-commerce business listening right now, what's your advice to them on being able to successfully grow their business based off everything you've seen across so many different businesses? I know that's a loaded question, but the best ability, to your best ability, as tactical as possible, what should they be looking at? How should they be viewing their company? And what are the important things to focus on right now?
Yeah, I would say one of the big opportunities, so it depends on the stage, depends on your scale, but I would say start to think about omnichannel and global probably earlier than you're comfortable. I think a lot of e-com businesses, even the omnichannel ones, they start to rely on like, well, I had a relationship with this local retailer, so I started to do wholesale, or I posted on my Instagram, my friends started sharing, and so like they're e-com businesses, but if you look at their customer footprint, they look like a brick and mortar business. I think this is where there's a massive opportunity for the people to figure this out and start to figure out like, hey, there's pockets of people in the UK or Germany or
sorry, I don't want to interrupt, but what you said was so powerful. I want you to just dive a bit deeper. When you say you look at their customer footprints, it looks like a brick and mortar business. Can you just unpack that? Because I love that you said that, and I don't want that to get lost in everything you're saying.
If like the internet is a massive store, and you can reach 7 point something billion people on the internet, and so as an e-commerce founder, why would you limit yourself to the people who speak your language, or at least like who can walk to your headquarters, right? And I think we see so many founders who go way too long, and they build up this personal relationship, and obviously like organic traffic is easy and cheap, and posting to friends and things like that ends up working, but there's just this massive opportunity to find pockets of customers that would fall in love with your product in other parts of the world. And it takes complexity, right? There's global supply chains. You've got to figure out how to advertise in those. They may be using different channels and things like that. But this is one of the areas we try and help people think through is, how do I think about myself as a global business? If you have ambitions to be a sizable brand, how do you think about yourself as a global business? Much earlier than you would if you were just a brick and mortar store, right? And how do you start to think about building a global brand? Because that's where there's real value, and that's where there's real untapped opportunity. And I think many e-commerce founders sort of fall into this trap of acting like a local retailer or coffee shop or restaurant. You're not constrained.
Yeah. First of all, I think it's a perfect segue. It's for a wrap up, because I think it ties into our first question about what did you learn at McKenzie, which is the same thing, right? They didn't think long game fast enough. Yeah. And you're saying the same exact thing here. I think one of the biggest things is, costs, right? People want to advertise, but they don't have the money, or they think that $500 on Facebook ads is what's going to make them $1 million business, when we know that doesn't go right, which is a perfect ending, because money is easy to find, especially with Andrew and his company. So now plug Andrew for the listeners who want access to funding in order to dominate their market, in order to become that global brand. A, how can they reach out to you if they love you and they want to talk to you? And B, how can they learn more about Clearbanc?
Yeah. Reach out to me on Twitter. I'm just Andrew D'Souza, or on LinkedIn. Feel free to follow me or connect with me. Happy to help. And then we're just ClearCo, clear.co, and you can sign up. You can reach out to somebody, and we're happy to walk you through. But we'd love to be able to help sort of this global force of e-commerce founders win and be more successful.
Love it. Andrew, thank you so much for your time. Really, really appreciate it.
This was a lot of fun. Thanks, Jason.
Hey, everyone. Thank you so much for watching this video. If you want, check out our most recent video over here. And this one is the one YouTube thinks you'll like. But if you really enjoyed watching, please do me a favor, like and subscribe over here. Thank you so much.